Welcome to today's session of the PPM Attorney Capital Forum. I'm your host, Darin Mangum, securities lawyer, managing partner of Mangum and Associates. Getting a little bit of a late start today, but just finished up a call with another client, and it was super busy, busy summer. As we're recording this. Of course, thank you if you're joining live. Welcome to the forum. Thanks for tuning in. And if you're watching this if you're watching this, this is obviously being recorded. So if you're watching this on your own time, then we're going to reference the outline that we've given out. Today's topic, equity securities offerings, which may sound complicated, but it's really not. It's basically different types of ownership interests if you're offering equity, right, or ownership interests in your company or in your fund or in your venture, whatever it happens to be, right? And obviously, there's maybe we can really cover briefly the advantages to doing equity offering versus a debt offering. I guess we can contrast a debt offering. There's other kinds of securities offerings that we're going to be covering in other sessions, but just really briefly, equity meaning ownership of your company or ownership of the vehicle or the entity that is set up to hold the assets or to facilitate the capital investment, pursue the venture, whatever it happens to be, right? Most entities that are doing equity offerings are like a corporation, like an LLC, or a limited partnership, right? Those are your common vehicles or entities that would be engaged in doing an equity offering, right? These same entities could obviously issue debt as well. Debt being the promise to pay them back in the future. The investor, instead of an owner in a debt offering, they're obviously a creditor, right? The company owes them money, right? The nice thing about equity offerings is that it's not money that you have to pay back, right? You're giving up ownership, or you're giving some degree of control to the company, to the investor, but it's not something that typically equity offerings, and we could get into some variations of that general rule in a minute, but ordinarily, equity investment, that they bought an ownership interest. That's not something that typically needs to be paid back. The investor's going to be, their reward for the investment is going to be upon exit, upon selling the investment or selling the interest down the road, or possibly receiving dividends or distributions of profits, right? So we can talk about some key common interests, like in a corporation. A very common equity interest is just common stock, right? We can talk about, again, when you're talking about just a regular corporation, and it keeps things simple. People have usually one vote per share. I mean, you could do different classes of common stock, but typically, in most cases, you're going to have one class of common stock, and then typically a corporation will have the right to issue preferred stock, right? Stock having some preferences to the common stock, right? And so we can get into the details of that. A common stock offering, again, it's probably the most basic, most simple. If you're doing like a seed round or just a simple offering, would involve the issuance of common stock in a corporation, right? And so usually you have one vote per share. They are common stockholders do have the right to vote for the board of directors, or participate in voting on certain corporate issues, like an annual shareholder meeting of this kind of thing, right? Those are your common features of a corporation, common stockholder, right? And for a lot of startup companies, that it is sometimes it pays to keep things simple, not to get too fancy, not to get caught up in you don't want to make the offering too complicated, right, for the investor to understand. Common stock is very easy to understand. Like, you've got you're giving the investor a share of common stock, right, and that translates into a percentage of interest in the corporation, ownership interest. Let's say you have 10 million shares of common stock that are authorized, and you've issued, or let's keep it simple, 100 million shares, right? That's and then let's say you've issued 10 million to yourself, and you're offering, maybe, let's say you want to give up, and so the stock that's issued to yourself, the stock, maybe we need to make a brief clarification on what the difference is between authorized stock and issued stock, right? Issued, or I should say outstanding, right? When you see the word outstanding, how many shares does a corporation have outstanding, right? That is where, how many shares have been issued of the total authorized number of shares. Let's say a corporation is authorized to issue 100 million shares, but they've only issued like 10 million shares to the founders. Well, that 10 million equals 100% of ownership of the company, right? Because no other shares have been issued, right? Once I issue, say, an additional million shares, so now there's not 10 million, but there's 11 million. Well, that 1 million is now, that is new shares out of the authorized batch that have been issued. So now the founders, instead of owning 100%, now they're going to own, what is that? I'll do some math real quick. I should be able to do that in my head, but 10 million divided by, so if I've issued basically just under 10% of the company, so now in that example, I start out with 100 million authorized, but only 10 million is issued to the founders, right? And then the founders, so instead of owning 100% of the company, if I issue an additional 1 million shares, now there's a total of 11 million. So that 10 million is only a little more than 90% of the total 11 million shares. So the founders have been diluted by around 10%, and the new owners come in. The new owners owning the million shares, the new shareholders, now own roughly 10%, right? So now that's the new, what we call the new cap table of the company, right? And so, and then you go forward from there, right? If the founders, you have to be careful with common stock, because let's say I issue another 10 million shares to new investors. Well, guess what? Now the founders only own 50% of the company, and the new investors own the other 50%. I've got a total now of 20 million total shares outstanding, right? If I go beyond that and I offer an additional 10 million shares, okay, guess what? Now I've got 30 million shares outstanding, and the founders only own a third, or like 33%. And so you see how quickly in a common stock scenario the investors could get diluted and ultimately possibly lose control of the company, because if each share of common stock is equal to one vote, right? Well, now if I've issued 20, if I only own 10 million and I've got 30 million outstanding, well, who's going to control the company? Well, the majority, right? The majority of those other 20 million shares, right, are going to own and control the company potentially, right? Now they would, they may be broken up into 100 investors, but still, they could all get together and say, hey, you know what, we don't like the founder anymore as CEO, and so we're going to vote him out. And you see that sometimes. You saw that with, the most classic example is Steve Jobs, right? He founder of Apple Computer, and at some point he different capital rounds had given up majority control, and so he lost control of the board, he lost control of the majority of the stock, and at some point they fired him, right? Kicked out of the company that you founded, right? How is that possible? Well, that's typically how it happens, right? And so now turning really brief, now you could issue potentially common stock that has no voting rights. That's sort of a hybrid, and we'll get into preferred stock. Preferred stock as well is where you're giving them ownership interest of the company, but typically the preferred stockholder coming in would have some kind of superior rights, right? Or what we call preferences, right? And the most basic preference being I've got liquidation preference. In the case the company is sold, right? I got to pay off the creditors, number one, and then the preferred shareholders typically get paid next. And if there's anything left over, and a lot of times there's not, right? Because the creditors took it all, or maybe the preferred stockholders took it all, and then, the common gets what's left, right, at the end, right? So, being a preferred stockholder from the investor standpoint may be more attractive, right? And so you see that sometimes where, maybe common stock isn't going to incentivize the investor enough, so maybe we'll offer them preferred stock, right? Which, liquidation preference, okay, that's kind of a given, not a lot to get excited about. What gets exciting when you offer preferred stock is when you're giving them maybe a preferred return, a preferred dividend, right? And it could be paid out if the company is cash flowing. If the company is still in a growth mode, maybe it accrues, but basically a lot of preferred stock, it's the promise to give them, hey, we're going to give you at least an 8% preferred return dividend on your preferred stock. This is just an example. And then once that's paid, then this is what would be called participating preferred stock, where they get their preferred return, they get the 8% dividend or 5%, whatever it is, and then they participate as any other shareholder would as a common shareholder, right? They get any sort of leftover dividend. So the preferred stockholder is, and when it comes to seniority as well, you could have different classes of preferred stock that have seniority over the others, right? Class A, Class B, Class C preferred stock could have different rights and preferences over other shares of stock, preferred stock, certainly preferred over the common shareholders, but even in relation to each other, you could have some preferred stock that maybe they have more voting rights. Like Facebook is a great example of this, right? Because, talk about a hybrid. I mean, it's got, Facebook, it has basically two classes of stock, right? They've got their voting common stock, all of which are held by Mark Zuckerberg, and then you have non-voting stock, which is held by everybody else, right? So even though they may have the economic benefit of owning the stock, they still don't have any degree of control. They can't even vote, right? And so oftentimes when you're structuring a preferred stock offering, it's common to say, hey, look, we're going to give you this preference, but we're not going to give you voting rights. In other words, the common shareholders still retain the voting rights. Like in the Steve Jobs example, Steve Jobs could have said, hey, okay, look, I'm going to grow Apple. Instead of just giving away common stock willy-nilly, I'm going to give you preferred stock, but this preferred stock doesn't have any voting rights, right? He could have done that, right? And I think he did do that at some point, but anyway, he wouldn't have lost control over appointing the board, majority control of the common stock. That's a lot of this when it comes to structuring the securities offerings. It comes down to control, and what is the investor willing to give up? The part, what is the investor willing to accept in order to invest their money? Right? They're obviously looking at, hey, how can I protect my money, and so on and so forth. And so, a lot of seed rounds, you'll see, again, very basic seed rounds. You want to keep it simple. You're just really trying to sell the concept of the company. Sometimes it makes sense to just keep it simple and do a common stock. You might say, hey, we're going to give a preferred stock, give some kind of preferred stock because it sounds more sexy. If you're dealing with like a venture capital firm, they're always going to want preferred stock, which gives them a lot of rights and preferences to appoint the board. And also a big preference that they usually negotiate for is the right is upon sale or upon liquidation of the company, they're going to ask for a preference, a liquidation, not only a liquidation preference, but they're going to ask for a multiple, right? Like, okay, if the company is sold, we're going to get a 1x, 2x, 3x on our money before anybody else gets any money. And I see this happen all the time with clients that accept venture capital money. They're all excited because they're like, oh, I didn't have to go out and sell a bunch of shares to the public. I just got it all from one VC. I got my whole 20 million or whatever from this venture capital firm. And I'm like, oh, that's great. Oh, great. Well, what are the deal terms, right? They got this preferred stock, and they also got, they got a liquidation preference, and they have a cumulative preferred return, and blah 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 blah. All these like conditions, right? And then also, and by the way, if the company is ever sold, they get a 2x multiple or 3x multiple, whatever it is, on their money. Upon exit, right? And so fast forward 5 years, whatever, the company, yeah, great. You see this success of this entrepreneur and they're like, oh yeah, I sold the company for $1 billion or whatever, and it turns out, well, how much of that did you take home? Well, they don't really want to talk about it because, I don't say $1 billion, billions. If you sold your company for $1 billion and you didn't take home anything, something's wrong, But if they'll sell the company, but then they're out there, they're not retiring wealthy. Who got wealthy? Well, all the preferred stockholders got wealthy because they had some 1x, 2x, 3x multiple on top of their preferred return. And then oh crap, well, who gets the leftovers? Maybe that takes up 90% of the value of the company, right? And then who gets left over? Well, the common shareholders did. The seed investors, that mom and pop grandma that put up the money to get the company off the ground, they get whatever's left, right? And if the company, unless you did sell for $1 billion, it's something less than that. Sometimes they're like, oh, okay, well, that may have been a base hit. It wasn't a home run. Who got rich? Well, all the preferred VCs did. And the founder, because they're sitting in the common stockholder position, they wound up with kind of whatever the leftovers are after the it's kind of like, Lion King, right? Whatever's left on the prairie after the hyenas come and the lions get their share, well, then Puma Matata, whatever, gets the rest, right? Whatever's left over. Anyway, but that's something that could happen in a preferred stock type situation. That's why you want to be really clear when you do structure a preferred stock offering. You want to run a couple hypothetical scenarios that outline, hey, what if the company sells for this amount of money? What do I get? And I've seen this all the time. I have a client that she has a supplement company, and it turns out that her partner owns a majority share of the company, and for her to really make any sort of profits if the company's ever sold, the company would literally need to be sold for like $1 billion, something like that, in order for her to make a decent payday, right? Because her common stock position had been diluted so much by new investment coming in. A lot of factors, right? Every company's different, but anyway. But yeah, preferred stock is a great vehicle. You can structure it in a way to make it feel like debt. You could structure an annual required dividend, or have it pay out a certain amount. You could have it convert to common stock. There's lots of ways to structure preferred stock. It just really there's no end to the variations of preferred stock that you can issue. You just want to be careful as a founder. Okay, every share of preferred stock you're issuing ahead of you in the common round, or ahead of the common shareholders. Okay, well, that preferred stock is going to have to be satisfied in some way at some point, right? So use it with caution, right? Or just know what you're getting into. And obviously, if you have a competent securities lawyer helping you, they can help you do that. And sometimes the market demands it, right? Because of market conditions, just regular plain old common stock offering may not be sexy or exciting enough, and so you have to sort of embellish the offering somewhat with offering up some kind of preferred return or preferred type equity position, right? Anyway, I'm taking a little drink here. Okay, how are we doing on time? Okay, I think we're good. Where's my clock? Okay, we're good. Anyway, so moving on down. Oh, so now we're getting into LLC and limited partnership interests. Okay. Okay, so okay, what? We could talk about the different types of entities, but typically an LLC or a limited partnership interest, those are, obviously the advantages of those are they're flow through entities for the most part. LLCs are kind of nice because everything we've been talking about with common stock, preferred stock, all of that you can do with an LLC. You can have a preferred LLC interest. You can do a common LLC interest. You could do lots of variations with an LLC. The main advantage of an LLC obviously is the flow through of taxation, right? Unless it, by some crazy means, it elects to be taxed as a corporation, which is possible, but in most cases, LLC is going to be a flow through entity, right? So limited partnership is your typical limited partners, they're the investors, general partner is the management. That's a very rigid system. Now both LLCs and limited partnerships are great for a lot of times if you're trying to pass through a lot of tax advantages, like with real estate. Typically you'd want to utilize an LLC or an LP structure to do that. A limited partnership interest is very straightforward. Limited partners are not, have zero control. They don't have any voting. They don't do anything. All they're doing is putting up money, right? LLC interest could be exactly the same way. Most of the LLCs that we set up are for private funds, like a private real estate fund, but they operate a lot the same way as a limited partnership, where the investors get instead of a limited partnership interest, they get what we call an investing membership interest, meaning that under the operating agreement, they don't have any voting rights, they don't have any management control. They're just investors, right? Really, it kind of mirrors an LP in a lot of respects, but not always. I mean, sometimes an LLC could be structured as you could offer preferred membership interest or common membership interest, voting rights, non-voting rights. All of that could be done within an LLC, right? And so, we really like LLCs because they could be really very flexible in the way that they're structured and the way they operate, right? Limited partnerships are less so that way, but a lot of institutional investors are more comfortable with a limited partnership structure, right? So that's why we continue to use them, and they're universally recognized around the world, right? LLCs are not so much, right? So anyway, but yeah, everything you're doing. I mean, we've even done limited partnership interests that have, variations of preferred equity type provisions, where you're giving the limited partners a preferred return, you're giving them certain advantages in upon the exit or sale over the general partner interest. A lot of that could be custom tailored to the deal, right? So anyway, yeah, so those are certainly the difference. We're talking about, again, broadly speaking, equity offerings. You're giving up some kind of equity interest depending on the vehicle of the corporation or the LLC or the partnership, right? I think in the outline here, considerations, factors influencing the choice between common. Yeah, so I think, again, it all comes down to control. Obviously, you're trying to attract the investor without giving away the farm, right? I mean, certainly you don't want to give up control. You don't want to give up too much ownership. At the same time, you're trying to provide the investor a good incentive for parting with their money and investing with you, as opposed to just putting it in the stock market or something like that, right? Anyway, so those are just factors you have to consider when it comes to what do you want this to look like at the end of the day after you've raised the capital and execute your business model. How do you want things to go, right? Are you okay with investors having control in the deal, having votes and being able to exercise influence, or are you trying to limit them? Most cases, it's to your advantage to limit them in a way. Still give them a fair deal, but at the same time, not give away the farm either, right? When it comes to valuation and pricing, I mean, again, when you're talking about valuing a share of common stock, for example, versus a limited partnership interest, typically you're going to try to value this, you're going to try to set the value of the stock in proportion to what you believe the equity value of the overall company is, right? And it's easy to get a little bit bigger than your britches in some cases. I see entrepreneurs that are like, oh, I want to issue $1 billion. I do $1 billion offering at $1 a share, because I think I'm worth $1 billion, right? You might get some naive investors to invest with you at that stage or that price point, but your more sophisticated investors, institutional investors, are going to kind of balk at that. And what you don't want to have happen is like a down round where you offered it at $1 a share at one point, and then later when you come out with a secondary round or secondary or third rounds of financing or capital raising, you're having to offer it at the same price or lower. That's just perceived as a negative, right? But yeah, as far as trying to price the stock, I mean, it's, again, there's not a hard science to it, but you basically have to back yourself into work your way backward into, okay, hey, what do we want to price this at? And again, looking at market peers in the market, other companies that are a similar value, trying to price that stock or price that equity interest accordingly. With respect to a lot of kind of venture type, like if it's just like an acquisition fund where like a limited partnership where you're just doing it's just a straight split of profits, like 80-20 split, then valuation of the units themselves are not as important. What's important is what's the value of the underlying asset, and is that going to return, generate a return for the investor, right, under those deal terms, right? So pricing of this specific share of limited partnership interest or a unit of limited partnership interest, maybe not as a big a factor as it would be for a corporation, right? Still, you've got to still have your at least one foot on the ground when it comes to valuation, because again, whether they realize it up front when they're investing or whether they realize it later, at some point valuation is going to kick in, and it definitely has to be within line of market market conditions, right? They don't want to overpay. Nobody likes to overpay for a stock on a seed round and then have it go public later, 5 years, 10 years down the road at the same exact price, because, or even less in some cases, because what they just overpaid for it. They overpaid. They took on all the risk, and they just basically, really that's the mistake of the promoters or the founders. They just, they sold at too high a valuation in the beginning, right? And so you want to price your offering so that the investors have a reasonable chance to have a win, right? Doesn't have to be a home run, doesn't have to be a 10x, but at least a base hit or potential to have a decent return. And so, if your goal is, say, hey, we want to be worth, $10 a share at someday in the future, hey, at this seed round stage, we're going to let investors invest at $1 with the hope that between now and when we do go public or when the company is sold, that the value has grown from $1 to that $10 mark, right? And again, it's not an exact science. It is a lot of it has to do with investor perception. A lot of it has to do with what's going on in the market. But those are just things to think about when you're pricing the securities, right? When it comes to regulatory compliance, again, whether it's dealing with whether you're doing a PPM for an equity offering or a debt offering or any kind of offering, you still have to provide full disclosure to investors, right? I've already given some case studies and examples throughout. Let me check and see if there's any questions here. Chris, he's got a question here. I've got a Delaware corporation who wants to offer preferred stock to the investors. What do you recommend? Well, Chris, I think, the fact that you're Delaware corporation doesn't matter. If you're wanting to offer preferred stock, I would say, again, I don't know what your cap table looks like on the common stock side, but I would say if you're offering preferred stock, you just have to look at what are the deal terms of that preferred stock. I would keep it simple if you're offering preferred stock. usually you can get away with, hey, we're going to give you obviously a liquidation preference because it's preferred stock, and also we're going to maybe give you a cumulative preferred return of, keep it conservative 7%, right? And at least they know they're going to get that someday. That's going to be a cumulative preferred return. And again, but I would say, hey, but no voting rights. We're not going to give you voting rights. You might say, hey, we'll give you conversion rights, like in case we go public, in case the company is sold, we'll convert you to common stock at that point. But yeah, I would just keep it simple, Chris, and just keep it that way. Probably I need to know more details about what kind of preferred stock that you're considering, but that all could be structured easily by a competent securities attorney. Let's see here. I think that covers this topic. Again, we appreciate you tuning in for the session. If we have any other questions that come in a little later, I'm glad to cover those. If you want to send us an email to forum@mangumlaw.net, we'll definitely get that and be able to respond to that. And again, if you're watching this, you can refer back to this outline that's part of the thing. We also wanted to introduce Marquee Equity. We did have a client just a few weeks ago that signed up with Marquee Equity to help them raise capital. And again, if you want an introduction to them, they do charge money to be engaged. This is on top of whatever legal costs that you've incurred for the PPM and all that. But it's really reasonable, to have access to that many investors. They've got thousands of investors, different kinds of investors. But yeah, to have access to that many types of investors, I think they charge around $3,000 to be engaged and to make these introductions. And then I think they want like a success fee on top of that. They are not licensed brokers. They're not like FINRA reps, and so they are based in India. They're based overseas, and so most of their investors are overseas, like international investors, and but yeah, we're glad to make those introductions to them, and but they do have several thousand U.S. based investors, different family offices as well. So we're glad for members of the forum, we're glad to make those introductions and introduce you to them. Again, if there's topics that you'd like us to see covered in the forum, please let us know that. We do this once a week, getting on and addressing everybody's questions, but typically we try to plan these sessions in advance. So, well, obviously they're planned in advance. Anyway, let's see. Next week's session is. Here we go. Next week we're going to talk about debt offerings. Okay. We're going to talk about debt, right? Different kinds of promissory notes, debentures, different kinds of debt offering. And in a lot of cases, a debt offering makes sense. And so anyway, we'll dive into that next week. Until then, thank you for watching, and good luck out there. We'll see you on the next forum. Thank you.